It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, commodities cooling. After an X Games big air type ramp over the past year plus in commodities, it appears gravity has begun to take hold. The economic bellwethers, copper and lumber, which are both significant inputs into the residential and industrial economies, have seen their prices fall precipitously in recent months. Lumber is down 27% in the past 3 months, and copper just found a new 17-month low, down almost 30% since the middle of April. This is alongside oil and agricultural commodities, which are also seeing pressure. After trading above $120 as recently as June, oil has fallen to $95 and agricultural commodities have fallen nearly 15% from the highs. It appears tightening financial conditions and slower forecasted economic growth are weighing on commodities prices, and we will be watching in the coming months for further indications from the commodities complex that growth and perhaps inflation are decreasing, which leads us to number 2, inflation expectations. Investment discourse of late has almost entirely gravitated towards inflation and Fed policy, and it appears market expectations are changing. 5-year forward inflation expectation, a measure of inflation beginning 5 years into the future, has fallen from 2.7% to 2.1%. The current expectation has also fallen from 3.75% to 2.75%. With consumer confidence plummeting, housing activity stalling, and manufacturing activity roughly flat alongside easing commodity prices, it appears the market is getting more comfortable with the idea that inflation can be tamed. However, if you ask consumers, they continue to feel the pain, with expectations for inflation of 6.6% over the next 12 months. It will be fascinating to watch the interplay between market forecasts, consumer sentiment, and interest rate policy into the end of the year, especially if inflation does indeed moderate. The June CPI report is forecast at the same rate as May at 8.6%. Number 3, rate cuts and recession risk. While there is no immediate indication that inflation has abated, a number of forward-looking measures hint towards the Fed being closer to accomplishing their stated goal of demand destruction and lower future inflation rates amid slowing economic growth. Under the hood, we're seeing some interesting developments, most notably that the market has begun to price in rate cuts roughly 12 months from now. As of a month ago, the Fed funds rate was expected to reach 4%. Now that number is 3.3%, with expectations to drop to 2.7% by December of 2023. Fed forecasts as of the last FOMC meeting remain well above market forecast. So what is the market saying? Well, it appears the probability of recession is high and increasing. Q1 GDP was down 1.6%, and the current Fed now forecast for Q2 is negative 2.1%. We could potentially already be in a technical recession. Interest rates across the board have fallen significantly, and we will be watching intently on whether or not the Fed can thread the needle on policy between the current high inflation rate and the prospect of low or negative economic growth. And that's been your Market Minute for the month of July. Thanks for listening.